The certified letter hit my farmhouse door just after sunrise. I heard the slap of it from the kitchen, sharp against old wood. By the time I stepped onto the porch, the mail truck was already turning the corner. Notice of intent to foreclose, 30 days. The HOA claimed I owed $18,400 in architectural violations. Wrong shade of red on the barn. Fence 2 inches over approved height. Cult lied. Agricultural activity on land zoned rural for 70 years. At the bottom sat the board president's signature, clean and confident. Across the road, 2 neighbors stood on their porches, pretending not to watch. A tow truck idled half a block down, diesel rumbling like a threat rehearsing its lines. I read the letter twice, folded it once, slid it into my back pocket. They thought I'd panic. They thought I didn't understand leverage. What they didn't know was their foreclosure depended on a bank I understood better than they did. But to explain that, I have to start with the farmhouse itself. I'm 56. Spent 20 years as a logistics officer before consulting for agricultural supply chains. My life runs on schedules, margins, and documentation. Chaos doesn't scare me. Sloppiness does. This farmhouse isn't some weekend hobby. My father built the back porch with his own hands. I inherited it when he passed, along with 40 acres of stubborn red soil that stains your boots for good. In winter, the wood stove pops and settles like an old dog. In spring, the fields smell like iron and rain. Every HOA due, paid early. Every form, filed. I keep ledger books on the kitchen table, neat columns in black ink. No prior violations, not one. I'm not flashy. The truck's 10 years old. The barn's older than that. But the land is clean, the fences are straight, and the taxes are current. This place isn't luxury. It's continuity. I'm restoring it slowly so my daughter has something solid in a world that isn't. I've always believed one thing. Paper beats noise. What changed wasn't me. It was the board. The shift started after a special election. Most folks barely noticed. A developer-backed slate took the board in one sweep. The new president wore pressed polos and spoke in polished, corporate phrases about protecting property values. The treasurer flipped houses for a living and smiled like every conversation was a closing table. They called it community modernization. Executive sessions multiplied, meetings shortened, questions redirected to email. Then the fines started. Quiet at first. A shed here, a mailbox there. Mostly older homes, mostly people who didn't argue. I read every monthly disclosure out of habit. Buried in the financials was a line item about refinancing the HOA's legal enforcement budget through a regional mortgage bank. It promised to streamline collections and improve compliance efficiency. Most homeowners skipped that page. I didn't. It wasn't illegal. It was strategic. Enforcement backed by a credit facility meant they could push harder, faster, without waiting for dues to cover legal costs. And soon enough, the letters stopped sounding polite. The first notice mentioned my fence casting a non-compliant shadow beyond approved boundary lines. I thought it was a typo. The second cited the barn trim. Apparently my red was 2 shades outside the approved palette. Then came aerial photos taken by drone, time-stamped and highlighted like crime scene evidence. Each letter carried a fine. Each fine compounded at 12% interest if unpaid within 30 days. It wasn't about aesthetics. It was about pressure. Then the certified envelope from their law firm arrived. Formal letterhead. Language sharpened. If the balance remained unresolved, they would proceed with lien placement. I went to a board meeting. The room smelled like burnt coffee and laminate cleaner. When my turn came, I asked how selective enforcement aligned with the bylaws. Halfway through my sentence, the microphone clicked off. Time, the president said, smiling. Before leaving, I formally requested a copy of the HOA's lending agreement with the bank, underwriting their enforcement actions. The treasurer's smile thinned. That's not necessary. 2 weeks later, they filed the lien. They recorded the lien on a Tuesday morning. By Wednesday, it was public record. I felt the shift before anyone said a word. Fewer waves from passing trucks, conversations that stopped when I walked into the feed store. Someone started the rumor that I was behind on payments. not dues payments. Like I was one step from bankruptcy. My daughter asked me that night, quiet as she stirred her plate, "Are we going to have to move?" That one sat heavy. In a lot of states, HOA liens can leapfrog a primary mortgage under certain conditions. Most people don't know that until it's too late. The board was counting on that ignorance. 45 days later, the foreclosure notice came. I didn't call a bulldog attorney. I didn't pound the table. I made 2 quiet phone calls instead, one to my CPA, the other to an old colleague from my banking days. The second call changed the temperature of the room. During the last downturn, when everyone else was pulling money out, I was buying. Quietly. Distressed regional banks trading at fractions of their book value. Nothing flashy. Long-term holds through an LLC I set up years ago. One merger rolled into another. Boards consolidated. Shares converted. By the time my former colleague finished talking, the picture was clear. The same regional bank underwriting the HOA's foreclosure credit line was majority controlled by the holding company I managed. I pulled the public filings that afternoon. The HOA wasn't just hiring a law firm. They were operating off a revolving legal credit facility, essentially borrowing against future collections to fund enforcement. And buried in the agreement was a clause allowing the bank to freeze that facility under formal risk review. I didn't smile, didn't pump a fist. I poured coffee and kept reading. Ownership alone doesn't mean much without grounds to act. Leverage only works when it's justified. Paper beats noise. But I needed more than shares. I needed proof. I treated it like an audit, 3 years of HOA minutes, enforcement logs, vendor payments. I built a spreadsheet the same way I used to track supply chains overseas, dates, amounts, patterns. The pattern showed up fast. Violations clustered around older homes, fixed incomes, widows, retirees, properties that hadn't been renovated to the developer's preferred aesthetic. Meanwhile, newer builds sailed clean. Then I saw the landscaping contracts. No bid awards to a construction company owned by the treasurer's brother-in-law. Invoices rounded high, deliverables vague. I cross-referenced violation timelines with recent sales data. Pressure, fine, lien threat, then listing. It wasn't illegal on its face, but it smelled coordinated. I scheduled a call with the bank's compliance officer, careful with my wording. I didn't mention ownership. I framed it as reputational exposure, tied to selective enforcement and insider contracts. Silence on the other end. Then measured interest. Back in the credit agreement, I found the clause I was looking for. Suspension permitted if collateral or enforcement practices create regulatory risk. That was the hinge. I ordered certified copies of every notice they'd ever sent me. The board announced my final foreclosure hearing for the following month. The community room was standing room only. Folding chairs scraped against tile. Fluorescent lights hummed overhead. The board sat at the front table like a panel of judges. Folders stacked neatly. Expressions rehearsed. The president cleared his throat and moved straight to agenda item 4. Authorization to proceed with foreclosure. My name sounded clinical in his mouth. I waited until public comment, walked up with a single black binder and set it on the podium. My hands were steady. Before I began, I asked for confirmation on record that the HOA's enforcement actions were financed through a credit facility with First Commonwealth Regional Bank. The treasurer answered casually. "Yes, that's correct." I nodded. "For transparency," I said, "I am the majority stakeholder of First Commonwealth's holding company." The room shifted, a ripple of whispers. As of 9 a.m. this morning, the bank's compliance division initiated a formal risk review into this board's enforcement practices. I didn't raise my voice. The president leaned forward, color draining slightly, and that was only the beginning. I opened the binder. "Under Section 8.3 of your credit facility," I said, "the bank may suspend advances if enforcement activity creates regulatory or reputational risk." A few pages turned at the board table. This morning, that clause was invoked. I slid a copy of the letter across the podium camera so the room could see the letterhead. First Commonwealth Regional Bank. Effective immediately, the HOA's legal credit line was suspended pending independent audit. No more draws, no more borrowed muscle. Without funding, their law firm couldn't proceed. Foreclosure requires motion, filings, appearances. All of it costs money. Then I placed the second stack of documents down, certified notices, payment logs, vendor contracts linking landscaping awards to the treasurer's family. A summary of selective enforcement patterns. A cover letter confirming the same packet had already been forwarded to the state's regulatory office that oversees community associations. The president tried to cut in. I looked at him and said evenly, "Paper beats noise. No shouting, no theatrics. Just silence settling heavy across the room. The real consequences would take weeks to surface. The unraveling wasn't loud. It was procedural. Within a week, the treasurer resigned, citing personal reasons, in a brief email that avoided specifics. The independent audit firm announced its review of enforcement practices and vendor contracts. 2 weeks later, the landscaping agreements were voided, pending conflict of interest findings. The HOA's law firm withdrew representation shortly after the credit line suspension became permanent. Then came the formal notice. Foreclosure action dismissed. No apologies. Just paperwork. The bank issued revised lending terms requiring governance reforms, open financial disclosures, competitive bidding for contracts, mandatory compliance training for board members. Access to enforcement funding would depend on meeting those conditions. No one was handcuffed. No squad cars in the parking lot. Just a slow dismantling of leverage, built on shortcuts. Power doesn't always collapse in flames. Sometimes it erodes under documentation. When the letters stopped arriving, the farmhouse felt quiet again. That's when I had to decide what to do with the silence. Spring came anyway. I repaired the fence to exact specification. Measured twice this time, not because they'd won, but because precision matters. The fields turned, dark and ready. Neighbors started drifting back over, slow at first, small talk, longer conversations, apologies without saying the word. I could have sued for more, stress, reputation, time. Instead, I asked only for reimbursement of legal expenses and proposed bylaw amendments. Caps on fine escalation, mandatory open voting, full financial transparency before any enforcement action. The audit freed up reserve funds that had been misallocated. We redirected a portion into quarterly homeowner workshops. Basis education on liens, credit facilities, and governance rights. Nothing dramatic, just knowledge. The foreclosure notice hangs framed in my barn office now. Not as a trophy, as a reminder. Panic is profitable for bureaucrats. My daughter asked why I didn't crush them when I had the chance. I told her, land doesn't belong to bullies. It belongs to people who take care of it. So let me ask you, has your HOA ever threatened something disproportionate? Do you know who finances their enforcement? Would you have revealed the leverage sooner or waited? Next week, I'll tell you about a retired mechanic and protected wetlands. The sun still rises over this farmhouse. Quiet. Earned.